So in this presentation, we're going to walk through our thesis as a firm and kind of give a high-level overview of how we see the space. And so when you look at Pantera, the way we see the space is that blockchain tech and cryptocurrency, we view them as underpinnings of a new financial infrastructure, similar to how the internet was the underpinnings of a new information infrastructure. And so what that means is the internet did two things. It revolutionized not only how content was consumed, but also how content was produced. And so, if you think about the internet, anybody, anywhere can pretty seamlessly and easily create content. The analogy I like to use is most people are never on the radio or never on TV, but almost everyone produces content on the internet. And so we think this tech is going to be similar to that, but for finance. And so if you look at the evolution of money throughout time, 10,000 years ago or so, the Yap Islanders had these Yap stones, and they are these giant stones that were basically used as a form of currency. And then a few thousand BC, you started to see commodity money start to form, people using things like gold and silver. In the 1700s, you had representative currencies, basically currencies that were backed by things like gold standard. And then in the 70s, you really had, full-blown fiat currencies that really weren't backed by anything beyond, the faith and credit of the government that stands behind it. And, as soon as the dollar came off the gold standard, it started to depreciate a lot relative to other assets. And Bitcoin is sort of a response to that. It came out in 2009, right in the middle of the financial crisis. And the idea was to create a form of money that was fixed, that couldn't be debased. And not a whole lot changed in the cryptocurrency space until about 2014, 2015, 2016, when Ethereum came out. And what Ethereum did is it basically took the concept of Bitcoin, basically sending money globally from point A to point B with very low fees, no intermediary, and added the idea of programmability to it. And what's really interesting is whenever you add programmability to something in computer science, it tends to get a lot more interesting. And so with Ethereum, you have the advent of these ideas called smart contracts, or basically computer programs that automatically execute various types of financial transactions. So any sort of financial agreement you could think of, everything from a swap to an option to a future, to an exchange transaction to lending, debt issuance, all this stuff can be codified as smart contracts on top of Ethereum. The one problem with Ethereum, though, is that it's not very scalable. It does about 15 transactions per second. It's still quite expensive to run. And so the next evolution is basically scaling Ethereum. There's some kind of new blockchains that are trying to do that, projects like Polkadot. There's also Ethereum 2.0, which is basically a whole new version of Ethereum that's designed to be much more scalable. And, in theory, should be able to do thousands of transactions per second at very low fees. And so if you look at what we're focused on as investors in the space, I would say there's about 9 or so different areas. Everything from infrastructure, developer tools, things that let people custody and store cryptocurrencies, exchanges and fiat on-ramps that let you get in and out of cryptocurrencies, projects that are working on payments, consumer apps, collectibles and NFTs. But really the center of everything is this concept of decentralized finance or open finance, where you have this new parallel financial system that's sort of basically built from the ground up. It's more efficient, it's digital, there's no T plus 3 days, it's T plus 30 seconds. Everything we invest in, in some way, shape, or form touches this new financial system, makes it easier. It's some building block or component designed to actually help make that happen. And so if you look at the idea of a new decentralized financial system, any financial system really has, 4 or 5 main components. And those same components or primitives are going to exist in the decentralized system as well. You have a unit of account, basically a currency used for trade and commerce. For most global trade today, that's the US dollar. And in crypto, it's sort of the same thing. In the early days, everyone would trade, altcoins versus BTC. These days, most people are trading things denominated in dollars. You have stable coins like USDC built by Circle. You have stable coins like DAI built by MakerDAO. that basically enable, cryptocurrencies that are pegged to assets like the dollar. And then you have exchanges to actually trade assets. You're starting to see decentralized exchanges really start to get a lot of traction. You see things like Uniswap that have launched where, some days Uniswap does 30 to 40% of the volume of Coinbase. And, that's with a team of, 12 to 15 people. And so that really gives you an idea of how disruptive this tech actually is. Then you have lending and issuance. You need basically ways to borrow and issue debt. And then the last two components are ones that kind of have a negative connotation in some sense in people's minds, but they're actually not that bad. Those are margin and leverage. There's ways to do margin and leverage that aren't dangerous. And one of the benefits of DeFi is that everything is open and transparent, so you can really see and follow what's going on, which is different than traditional finance, where it's really opaque and hard to follow how much leverage exists in the system, and what exactly is going on under the hood. In DeFi, it's all open source and open to the public. And so if we dive in on a specific use case, if you look at crypto lending, that's had a huge amount of traction in the past year or two. It's one of the most popular use cases. The use case here is basically people borrowing against their cryptocurrency. There's different reasons you might want to do that. One might be if you're trying to, short an asset in this space. You would say deposit USDC or Ether, borrow the asset you wanted to short, sell it, and then pay it back at a later date. The other use case is if you wanted to buy something, or basically buy on margin or buy something else in the physical world without selling your crypto. And so today there's about 20 billion locked in these lending protocols. A year ago, it was under $1 billion. And so it's over 20x growth in the span of a year, which is just really mind-boggling numbers. The next area is decentralized exchanges. So this is what I touched on earlier. They basically allow you to trade digital assets without the need for a third-party intermediary. So you don't need to go, create an account on a site like Kraken. You just open up your browser, go to Uniswap, and you do the trade right then and there. You own your own funds. And the idea is that long-term, you should be, offer you better rates because there's not a middleman in the middle who has a huge operating expense to cover their costs. And in practice, that's starting to play out. A couple of months ago, I was looking on Uniswap, and you could actually trade about $1 million worth of ETH at better rates than you could on the Coinbase order book, which is just mind-boggling. I didn't even think that would happen this fast, but it is happening, and it is a real phenomenon. And I think it's gonna be a real force that continues into the future, especially as this stuff gets easier to use. And so right now, there's about 17 billion locked in decentralized exchanges to provide liquidity. There's 5 to 10 decentralized exchanges that are actually quite important. The volume of DEXs is growing rapidly, over 20 to 30x in the past year again. And I think this is going to be a really lasting force in the space. And with that, I'm going to turn it over to Paul. He's going to walk through the DeFi ecosystem and some of the players in that.
Awesome. Thank you very much, Joey. Basically, going back to the DeFi ecosystem slide, as Joey mentioned, we need scalability for DeFi to really take off. It's taking, all the way up to hundreds of dollars to make an Ethereum transaction. And, if we're really thinking that decentralized finance is also going to decentralized, access, so that, anybody can access, all of these different protocols, then we really need to make the gas fees much lower. And so, starting about 3 years ago, projects like Polkadot and Cosmos, and then more recently Mir, emerged and are helping to sort of solve the scalability problem. And eventually a lot of applications will be built on top of these protocols. And so with competition really pushes the ways to bring those fees down. And we're investors in, all of those right there. And moving up the layer a little bit, we have oracles, which is also necessary infrastructure for decentralized finance. So if you can imagine a decentralized prediction market like Augur, if you're making a bet on who's going to win a basketball game or an election, you need to be able to actually, have data that determines who is actually going to win. For Augur's case, they actually have people, providing the oracle or providing the data to help settle these markets. But API 3 and Chainlink are partnering with different data providers so that they can bring data into settle these markets for these decentralized protocols. And then moving higher up the stack, we have some of the things that Joey was talking about: lending, Maker, Aave Compound, decentralized exchanges, which, as Joey mentioned, is having some tremendous growth these days. Some of the ones that we haven't really talked about yet are around marketplaces. So anytime there's a two-sided marketplace, there is usually an intermediary that's taking fees, similar to how eBay is taking fees every single time a buyer and seller transact. Well, with decentralized finance, with the blockchain, you can actually remove the intermediary, and therefore you have marketplaces around, music streaming like Audius, to Origin, which is basically doing for any sort of e-commerce transaction, file storage like Filecoin, LivePeer like compute and streaming. So that becomes really compelling. And then on the payment side of things, we have new assets that make transactions faster, cheaper, and more transparent. And then, of course, Mirror provides synthetic exposure, where you can actually mirror the price of Apple stock and give Apple stock or any sort of US stock exposure from the international markets, which is really cool. And then higher up the stack, you get closer to where the consumers are interacting with the protocols directly. And they range from decentralized derivative exchanges to actually at the top of the layer or top of the stack are around wallets and aggregators. So basically taking away the complexity of protocols underneath and making it very simple for users to either get yield or to trade across different protocols. So 1inch is a top decentralized prime brokerage for cryptocurrency trading. Instadap helps you get yield across different protocols, and Bald is basically a BlockFi that helps you get yield on any sort of cryptocurrency that you lend. And so, as you can see, value locked in DeFi protocols has grown tremendously. I mean, it's gone from about $500 million slightly over a year ago to now about $50 billion. And a lot of that growth is coming from decentralized trading volume, which is now facilitating on a monthly basis about $70 million a month in trading. And so, as Joey has mentioned, we've seen Uniswap on average do about 30 to 40% of the volume of Coinbase, but on certain days, Uniswap's even doing more volume than Coinbase. So, again, with capital efficiency, the accessibility of different markets that you get on decentralized protocols versus centralized businesses is astounding. And so the number of assets that's on these decentralized exchanges versus these centralized exchanges make it a go-to place for initial trading for retail traders in the space. So it's astonishing how fast the growth is going. And I wouldn't be surprised if we go over 100 billion locked up in DeFi by the end of the year. What's also really helping to fuel decentralized finance and usage of Ethereum are these assets called stablecoins. Stablecoins come in two different ways. Some are actually pegged to the US dollar, and those are the ones that have most of the value that's locked up right now. So Tether, USDC, Binance USD, etc., where for every single stablecoin, a unit of stablecoin for each of those, it is actually backed 1-to-1 by an underlying US dollar. But we are seeing some stablecoins out there that aren't pegged to any sort of fiat currency and are algorithmically pegged based off of either gaming mechanics or some sort of bond market or other sort of mechanisms to really just incentivize people to be either buying or selling. And those are starting to get some traction. And, we can probably talk about that later on as we talk about some of our newer deals. But, what's interesting about stablecoins is because they are on the blockchain, and most of them are on Ethereum, but again, some of them are on Binance, you can actually programmatically use them for collateral or just cross-border payments. And so while I think Bitcoin has been mostly used for cross-border payments, I actually think stablecoins will eclipse Bitcoin in terms of cross-border payments. And it's really exciting to see the growth of it go from basically zero all the way up to now $54 billion. And the last category that I'll talk about is NFTs, or non-fungible tokens. But the beauty of the blockchain is that it really provides trust in a way that can't be manipulated. And so because the blockchain is immutable, it's great for tracking things and tracking ownership of things. So, if you buy a piece of artwork or a Monet, sometimes it's hard to sort of know if it's real or not. But if you're able to put that serial number or engrave that onto the blockchain that this particular item is authentic, and be able to actually trace that ownership on a ledger that is immutable, that becomes extremely powerful. What NFTs are doing it's enabling digital forms of valuable artwork or music, songs, videos, game items to actually have value and to actually have scarcity, because only a certain number of these are going to be created and they can be tracked on the blockchain. And because of that, it will have value. Blockchain can actually bring scarcity, it can track ownership. And so some of the great examples of this are a piece of artwork that's sold on Christie's over a blockchain platform, with NFT, has sold for $69 million. We're seeing artists like, 3Lau, Kings of Leon, selling audio clips and music albums for millions of dollars. More recently on Nifty Gateway, The Weeknd just started selling some NFTs on there for over $2 million. And we're starting to see, celebrities like Justin Bieber and Lady Gaga get into this. And then on the video side of things and gaming side of things, I think it's really neat to be able to see video clips of, old basketball players, Michael Jordan, LeBron James, and have those collectibles be traded on the blockchain as NFTs and have scarcity, et cetera. So, we really think that whether it's, items that we normally do see right now, such as highlight clips that really do get tokenized and bring scarcity, to actually new types of artwork that not only famous people can create, but anybody can create. I guess the last thing I'll mention is there is one meme, or this one person that I think her handle is overly attached girlfriend or something like that. And she created her own artwork, which was her face with a painting that she did, and sold it for $400,000. So we're really seeing a new revenue stream for a long tail of artists and the creator community, which is really cool. So I'm going to pass the baton over to Dan to talk about some of the reasons why you should get into cryptocurrencies right now.
Thanks. And with that, we want to talk about the markets and answer the really important question, why now? We've been advocating for blockchain for 8 years. The technology's been developed, the community's being built, all kinds of great things have been happening that we're talking about this week. The unprecedented monetary stimulus really adds an impetus right now. When the pandemic began entering our consciousness a year ago, I didn't know what impact it would have on our community. I didn't know what impact it would have on my family, anything else. Everything was so confusing. But the one thing that was incredibly clear, it was going to have a massively positive impact on things whose quantity cannot be eased, like cryptocurrency. And we've seen that in the monetary stimulus the United States has done. In the month of June, the US printed more dollars than they did in the first 200 years of the country's existence. That's a larger deficit in fiscal 2020 than in any year during World War II. In World War II, we were fighting global fascism. Here, we are using printed money to essentially paper over the damage caused by the virus. The scale of this is really hard to get your head around. The fiscal 2020 deficit was equivalent to $14,500 per adult in the United States. That is an extremely large amount of money. And to put it in very fine perspective, that is 1,000 times the cost of a dose of vaccine. The deficit for the next year is probably going to be even larger than that. And with continued money printing, that's putting pressure on things whose quantity can't be eased. So the price of Bitcoin, gold, even corn, soybeans are going up. And I think the best proof of the monetary stimulus impact is the S&P 500, which corporate earnings are being killed in a global depression, is setting new records. So that proves our thesis that with unprecedented amount of money sloshing around the system, it's creating higher and higher prices for things whose quantity can't be eased. The flip side is to view it as maybe all those prices are actually relatively steady, and the thing that's actually moving is the price of paper money. That has brought in legendary investors into the space. Stan Druckenmiller's got in recently, said it reminds him of gold. Paul Tudor Jones as well wrote in his investor letter that it reminds him of gold in the 1970s. I think that's a great analog when inflation and money printing were at doing what at the time was unprecedented. The price of gold went way up, and I think you're seeing an analog here. We also have a lot of very high profile investors investing in the space, like Elon Musk. Bill Miller's been an investor for 5 or 6 years in this space, and that's making it easier for institutions to get engaged in the space. That is seen by some of the massive endowments and corporations that are investing directly in cryptocurrencies and blockchain tech. You've seen many of the top endowments get involved, very high profile companies like Tesla. And then MicroStrategy is a very interesting case. It's a $1.5 billion software company that put $1.5 billion worth of Bitcoin on their balance sheet, and now they're a $7 billion company. So it's encouraging more and more institutions to put crypto into their treasury or onto their balance sheet. And we've seen that in companies such as, very old companies like Bank of New York Mellon. PayPal going live was a huge impetus. It made it much easier for people to get money into cryptocurrency. It used to be very cumbersome, particularly in the 2017 run-up. You'd have to take a picture of yourself with your passport and send it to your exchange and wait for a week for their AML KYC team to approve you. And now with one click, you can buy cryptocurrency. And that's allowing more and more people to get involved. And just recently, Morgan Stanley announced they had approved cryptocurrency for their high net worth clients, and I think that'll bring in a great deal of customers. The big reason institutions had been delaying investing in the space in the early years was the lack of institutional infrastructure. And I'm happy to say that all of those issues have been resolved. There are fantastic companies in each of these important segments. In the exchange space, obviously you have Coinbase, which is going to a direct public offering. You have the CME group doing futures just in the same way they do futures on other products. The Intercontinental Exchange, which is the owner of the New York Stock Exchange, has an exchange called Bakkt, which is doing Bitcoin custody and trading with the very same security and infrastructure as all the New York Stock Exchange and the other 13 exchanges in ICE. That has made it much easier for people to decide to trade cryptocurrencies. And then institutions obviously are very concerned about custody. In the earlier days, there really weren't large, well-capitalized regulated custodians. That has been taken care of as well. You have industry custodians like BitGo and Coinbase, but then again, you have firms like Bakkt from the outside. Fidelity has many years, 5 or 6 years of experience in the space, and they've been doing custody as well. And the last is prime brokerage. It's often very difficult to trade. We know that. We've been the first institution to be trading cryptocurrencies, and it's used to all be done over a cell phone, and that was very inefficient. Now we can electronically trade through some of our portfolio companies like Amber and Tagomi, which was acquired by Coinbase. The last issue for institutional investors is regulatory clarity. And that is the one topic where there's still just a bit left to be done. Many of the regulatory bodies in the United States ruled very early. As early as 2013, most of the major regulatory bodies ruled. And in every case, they ruled in literally the best possible way. The IRS ruled that cryptocurrency is property. So if you hold cryptocurrency for a year, you get long-term capital gains tax treatment. And that's much better than the tax treatment you get on gold, which is taxed as a collectible. And then paper currency is always taxed as ordinary income. You could have bought the euro 20 years ago and sold it at a profit today. Now it'd still be ordinary income. The CFTC has been very progressive. They started doing serious work on cryptocurrency in 2013 and approved futures in 2017. So that's been very helpful in credentializing the industry. The OCC allows any nationally chartered bank to custody cryptocurrency. So all of those have been resolved. The only one that's left is the Securities and Exchange Commission. And I'll admit I have a great deal of empathy for them trying to figure out whether these very interesting and innovative distributed ledger technologies are either similar to or dissimilar to an orange grove that Mr. Howey developed in Florida in the 1940s. There are a few things like Bitcoin and Ethereum that have been ruled to not be securities. And there are some things that have ruled to have been securities. And we need to clarify the middle ground. One of the important things the SEC will be looking at in the future is whether Bitcoin ETFs should be approved. And there's a great deal of debate on whether there's a higher standard being imposed on cryptocurrency than in things like platinum or palladium, which might have very small, much smaller and more easily manipulated markets. So with that, I want to talk about the markets themselves and why we think this is a kind of once in a generation opportunity. When I was at Tiger Management, we spent all of our effort looking for very asymmetric trades where the upside was way more than the downside. That is what cryptocurrency is. Cryptocurrency is a market that is disrupting the biggest markets on earth. And if it works, you can have returns that are much, much larger than your downside. For many years, I used to stress with investors, you could lose 100% of your money. And so don't put in more than you're actually willing to lose. Now, I think it's no longer true that blockchain could ever actually just go away and you could lose all of your money. But in the extreme, you should think about it that you have 1x your downside and you might have, many multiples your upside. The markets they're going after, the biggest ones on earth. So you're going after money, which is 100 trillion, going after gold, which is, had a good run for 5,000 years, but it has some, antiquated aspects to it. And all of those markets are so much bigger. And this is just a stylized example of that. Cryptocurrency is disrupting dozens of different use cases. So what does that opportunity look like? We often have a hard time looking at the price appreciation of very disruptive things like Apple stock or Amazon stock. So in order to do that, here we've graphed in a log basis. The so-called crazy price moves of Bitcoin actually look relatively sane when you look at it on an exponential basis. Bitcoin has been growing at a 213% compound annual growth rate for over 10 years. There have been a couple bubbles and there have been 5 bear markets, but generally it has been remarkably consistent. And there's often a competition in this space for pundits to throw out their craziest forecast of where Bitcoin will be. And what I've been saying for many years when people ask where I think Bitcoin will be next year, I just say it's going to be 3.2 times where it is today. And it remarkably does that very well. When I started out as a bond trader, I came in every day and just thought about bonds. I didn't think about equities. I didn't think about commodities or oil or anything else. These days, modern portfolio theory has been so successful that everyone basically has the same portfolio. And that means everything is super correlated to each other. And so when there is an exogenous shock like the virus last year, that means everyone wants to reduce risk at the same time, and they're all essentially selling the same thing. There's really no alternative in alts anymore. Bitcoin has the unique property of being the highest returning asset class that I know of, 213% CAGR, and having zero correlation to anything else. And that is the dream asset to have in a portfolio. And that's really one of the reasons to think about every institution should have a few percent of their assets in Bitcoin, because it does have the ability to have incredible returns, but also is very uncorrelated. That won't last forever. In 10 years, when everyone does have a blockchain team and everyone does have a blockchain allocation and everyone's invested in the space, it will pop into this matrix just like everything else in being highly correlated with the rest of the markets. So the next question is, how does one value cryptocurrency? And I know this is an unsatisfying answer to some: supply and demand. And I had a fun debate with one of my Tiger Cub friends who's a TMT investor. And he said that they don't trade Bitcoin because there's no cash flows to discount. There are no cash flows to the euro either, but no one thinks twice about trading the euro. And that's really how one should think of this. Bitcoin is a fixed quantity. It's like the gold standard. There's 21 million units of Bitcoin. And if more people want to use Bitcoin, the price will go up. And that's essentially what's been happening for the last 10 years is the demand for Bitcoin has been increasing. We've seen that this year. We had, or like I said, late last year, we had PayPal go live. Now we have Morgan Stanley going live. A bunch of other firms are likely to follow. That is increasing the demand on Bitcoin. It's bringing more people in. A lot of the holders of Bitcoin hold it for gains, but ultimately a lot hold it for kind of political philosophy reasons. And so don't really want to sell it unless it's a much, much higher price. That makes the curve very steep. And then the supply has been cut last year. We had the third halving in the history of Bitcoin. So for those of you who aren't familiar, Bitcoin has a fixed money supply formula. Every 10 minutes, a certain number of Bitcoin are issued. And then every 4 years, that number is cut in half. And that has had a massive impact on the market. This graph shows a representation of the log price. And the lighter shade of gold is the year and a little bit before the halving. And then the darker gold is the year and a bit after the halving. And those two periods have historically seen the biggest run-ups in price. And it stands to reason that if you have a constant or growing demand, as we've seen, and then you have the supply cut in half, that is going to have a big impact on price. And we have studied the previous halvings and determine a forecast for the price of Bitcoin going forward. The way we did it is we took the reduction in the flow of Bitcoins, or the supply of Bitcoins, relative to the outstanding stock at the date of the halving. The first halving happened when there were very few Bitcoins outstanding and took out 15% of the stock of existing Bitcoins. So the flow was cut very dramatically and had a massive impact on the price. In 2016, the halving was obviously half as large and the outstandings were greater. So it had about a third the impact. It took 5% of the existing stock out of the future supply. And it had a 1/3 as large impact on the price. We used those ratios to estimate this halving, which again is half as big as the last one, and there's more outstanding. It's about 2% of the stock of Bitcoins being pulled out of future supply. And that implied a curve, which we published a year ago, showing where we thought Bitcoin would be. It's been remarkably accurate. We are predicting that Bitcoin will hit $62,968 in the coming weeks. And to date, it's been historically very close to that. So the last kind of knock on Bitcoin is, it's so volatile that maybe, it's inappropriate to have in a portfolio. Obviously, one of the ways to mitigate that is to change your investment size. Obviously, you don't want to put 10 or 20% of your portfolio into something that has high volatility. And on that, Bitcoin's volatility is high. It's 70% annualized. So one would want to put less in it than they would other types of lower volatility assets. But to put that in perspective, that volatility is only just a little bit higher than the volatility of Amazon stock. And Amazon stock is a similarly disruptive thing that's even just a little bit older. So Bitcoin's volatility has prompted 5 big bull markets and 5 bear markets. Those 5 bear markets have averaged an 83% drawdown, which I know it sounds very scary that if things go down 83%, you know, they must be very dangerous to your portfolio. The punchline is the price goes up so much that even after 83% bear markets, it ends up higher than it began. There's only one calendar year where Bitcoin's had a low lower than the prior year. We haven't updated this graph, but 2021's low is $28,723. So the volatility of Bitcoin may sound scary at the outset, but it's such a disruptive thing that over time it comes out of the wash. And in the past, anyone who's ever held Bitcoin for 3¼ years has made money. And with that, I want to thank you for participating in this panel.